to the Power of Zero show. This is your host, David McKnight, best-selling author of The Power of Zero, Look Before You Lerp, The Volatility Shield, and Tax-Free Income for Life. If you're looking for help navigating all of the pitfalls that stand between you and the 0% tax bracket, head on over to davidmcknight.com. We'll connect you with a member of our elite POZ advisor group, among the very best tax-free financial planners in the nation, trained, vetted, qualified personally by me. If you are a financial advisor looking to level up your game and incorporate Power of Zero principles into your practice, head over to powerofzero.com, opt into our free 3-part video series. If you're looking to buy any of my books in bulk discounts where you can mix and match titles, head over to davidmcknightbooks.com. If you want to buy individual copies, just do that at Amazon or wherever you buy fine books. If you want to follow me on Twitter, you can do so at McKnight & Co, at McKnight & Co. Today, we are going to, I'm going to show you the first half of my interview with Rebecca Walser. She is the author of the best-selling book, Wealth Unbroken. Let me tell you a little bit about Ms. Walser before we get going. She's a licensed tax attorney who earned her advanced law degree in federal taxation from the highest rated tax law program in the U.S. at New York University. She is a certified financial planner with 2 decades of financial and legal experience combined. She earned her undergraduate degree, summa cum laude, in finance, her Juris Doctorate degree, cum laude, from the University of Florida, her Master's of Law degree in taxation from NYU, worked in international finance with PricewaterhouseCoopers, LLP, and continues to practice law in the areas of federal taxation, wealth preservation, trusts and legacy planning, business succession, estate planning, and asset management and protection. We had a wide-ranging discussion that we'll divide into 2 podcast episodes, so sit back, relax, and take in the first half of my interview with Rebecca Walser. Rebecca Walser, welcome to the Power of Zero show.
Thanks for having me, David. Really excited to be here.
Well, good. I had the opportunity over the weekend to read your excellent book, Wealth Unbroken, and it sounds like you and I are sort of 2 peas in a pod in terms of how we view retirement and how we view the investment world. So I'm really looking forward to this interview, bouncing some ideas off you, getting your thoughts on a whole range of subjects. So this is really red meat for me. It's wonderful to find a kindred spirit where we really see eye to eye on so many things. So I'm just going to start off. I've got a series of questions. I'm just going to dive right in.
Yeah, please. Please.
You talk about in your book how you think that the 401k is a failed experiment. You want to elaborate on that?
Yeah, and I'm sure your listeners have heard this from your book and Power of Zero, many of your guests. But from the law side, the Revenue Act of '78 was really a corporate tax dodge. It was really for highly compensated executives, and now we're talking about the 401k provision in its birth. And it was really a tax dodge for highly compensated executives on top of a golden parachute, a pension. It was really intended to be for people that would have access to professional money management, and it certainly was never tested or even thought of as a mainstay retirement vehicle. This is how it came to be in the Revenue Act of '78. And as you know, it was a benefits consultant at the Johnson Company, not Johnson & Johnson. It was a benefits consultant that was looking for a way to do an alternative savings plan as opposed to just a cash bonus savings plan at a client of the benefits consulting group. And they came upon this 401k provision and basically saw that, hey, this is a tax dodge that we could probably leverage if we can agree that the IRS will allow us to not be taxable, because otherwise you'd have obviously phantom income. If you were, putting money aside that you weren't accessing until you were either vested, you left the company a certain age, and you had to pay taxes on that immediately, that would be taxes on phantom income. So they just needed to make sure that the IRS would in fact, honor the pledge that it wouldn't be taxed until the funds were accessed. And obviously once that was rolled out as an actual retirement plan, and it caught like wildfire. You have to remember back at that time, David, this is the time where corporations were severely underfunding their pensions. And so on the defined benefit side, they were responsible for putting the money away, investing the funds, having enough to honor those pensions and meet those obligations. And so when you had the 401k provision come out that basically was shifting the burden to the individual to basically, one, they had to first elect to make the contribution, right? And then instead of putting aside enough funds to guarantee or to, actuarialize. So, you have actuarials that are going through and saying, this is how much you need to put away for a person this age with this sort of pension level benefit, 75% of their base, projected to be this much by the time they retire if they stay with us. So you have a lot of actuarial math going into all of those requirements, and they were severely underfunded. And that was a time where Congress was starting to really crack down and say, you guys need to really start funding these pensions because you're not going to be able to bring the money out of thin air. A problem that we're facing now at the state level, it's a crisis, the crisis of the pensions. So you had these people, you had CFOs say, oh my gosh, this is like the solution. We can stop funding our pensions. We can make the onus on them, and we only have to match them some god awful small percentage compared to what is our responsibility to do on the defined benefit side. And so you can see that it's just a sea change shift to defined contribution. And when that happens that way, there's no testing, there's no analysis, there's no white papers, there's no mathematics that is run to say, hey, is this vehicle that happened by accident really the vehicle that we should be leveraging as the mainstay American retirement vehicle throughout all of the country, throughout all job levels, throughout all is this the right vehicle? Of course, Wall Street is a huge fan because if you think of the concept of dollar cost averaging, right? Think of all of the millions of workers that all of a sudden now have access to funnel money into Wall Street that never had that direct access before. It was really a stockbroker world. You really had to call your stockbroker to make trades back in the late 70s, early 80s. If we go back to those timeframes, I mean, certain high net worth people had access to private banking and all of that, but I'm talking about specifically this mainstream America not directly investing in the markets. And now Wall Street's got massive millions dollar cost averaging in. And this is the way Wall Street just exploded as well. So it was a win for Wall Street. It was a win for companies. And I think over time, and certainly what we've seen with the retirement gap, the wealth gap, the savings gap, that it is actually a loser for the American people.
One of the things that I thought was really interesting that you brought to the fore in your book as it relates to the 401k is we went from a system where really the employers were doing all of the investing. They were in charge of all of the professional money management to make sure that those pensions grew in the right way so that they could honor the promises they made to those employees. But one of the observations you make is that there are issues when you shift the burden of investment selection onto the backs of the employees, backs of the investors. What are some of the downsides of having the employee being in charge of the investing versus the employer managing that facet of it?
That is an excellent question. And it's really something that everyone should understand, because if you understand that when you're dealing with your own money, you are an emotional investor. We are humans and we are attached emotionally to our money. This is why, David, we're not anti-market. So I just want to clarify that. A lot of people think, well, you're a very much leverager of life insurance and insurance-based products. And as a tax attorney, I absolutely am a massive leverager of life insurance, even though they're trying to chip away at our ability to use that, from a tax perspective, as 7702 and the things that have happened this year. But that aside, we are pro-market. The problem is what people don't understand. If you look at the Dalbar studies, if you look, all of the studies where we've studied longitudinal investment choices, we human beings, and specifically Americans, we don't even make the minimum averages of any of the indexes. We are substantially, if you look at the 30-year Dow Dow bar average, the 20-year Dow bar average, the 10-year Dow bar average. We are substantially under the averages for the markets. And if you stop and say, why? Like, why can't I just buy the S&P 500 Spider ETF and call it a day and do great? Because people don't do that. What they do, and I've seen them, they've sat across my conference table, right? And I'm sitting there with them and I'm saying, looking at their positions, and we're kind of looking through them, and I'm saying, well, this one has a long runway, I'm happy with this, but this has got issues. And you know what, I remember distinctly one gentleman, I was talking with them and I was specifically zoned in on one specific position, and he's like, I know you're right, Rebecca, but just last week it was $1 higher, so I just want to wait until it goes back up and then I'll sell. And so what happens is we have this anchoring phenomenon. So much of investing is human psychology, behavioral economics, behavioral finance. And when you realize the psychology that you're dealing with and how it tricks you into making the wrong choices. So here's a gentleman that I'm sitting in front of saying, I believe this position is going to go nowhere but down. So let's sell while we're still up. And he does not want to sell because he phantomly has anchored to the $1 higher price last week. And now his brain is telling him, if I sell less than that higher dollar from last week, I'm losing, even though he had a long time gain in that position because he had been in that stock for a long time. He had anchored to that dollar. So what he does is he doesn't sell. There's one piece of advice I'd say I agree with, David, because I'm pretty much a contrarian for most of what Wall Street says and does. And I think you are too. But the one piece of advice that is absolutely right every single time that you can take to the bank forever: buy low, sell high. Buy low, sell high. And when you look at behavioral finance, what you realize people do is when the market is high, like it is now at what I believe it's all-time high, and it's going to revert to the mean, you have FOMO, fear of missing out. You have people that even though their portfolio is 40% off of the high pre-corona, so we're 40% off of our high before the virus, and they still think there's more space for it to grow. And so they don't want to sell out. So that's number one. They know it's high, but they want to stay in because they think they'll miss out on a high upside. There's a little saying that I use in my book, pigs get fat. It's okay to be a little bit piggy with our money and want it to grow as much as we can. But when we cross over from being a pig to being a hog, that's when we're going to get slaughtered and the market's going to slaughter us. So that's the first thing. People don't want to sell, even though it's the top, because they think that there's still fear missing out. They're going to miss out that second there. But then let's talk about the opposite side. When they start to see, like me with that gentleman, a stock coming down, right? And I'm telling him this stock has got nowhere to go but down. All of these reasons I gave him, all the technical reasons, and you know what? He just wanted to go up to that dollar and then he would sell. Well, guess what happens? You stay on that track and it keeps going down, and it gets to a level finally where he gets to the point where he says, well, I can't afford to lose any more on this position. And then he sells when it's at the bottom. And so people, by nature, our nature is against us because we do the exact opposite of what we are supposed to do when we manage our own portfolio. And so not only do we have the problem that people do not understand that you have to have over 30 picks in a portfolio to get rid of the idiosyncratic or company specific risk. They don't understand diversification. They don't understand modern portfolio theory. They don't get these things. So we've got all those issues because they're just lay people that are just trying to, do what's right. But then they also have the economic, emotional psychology against them. And it really relates to just a disaster, which is why you have the Dow bar statistics showing that the average investor has just done so much worse than the markets and the indexes themselves.
Yeah, so you, in your explanation, you touched on something that was sort of a recurring thread throughout your book, and that's that people like you and me have widely divergent views from the average financial advisor on the market. You talk about how there's two different types of financial advisors. You talk about how our views do diverge widely on taxation, on life insurance, and a whole slew of issues. Talk about the two types of advisors and why they see that investment world so differently.
Yeah, it's a great question. I think for me, I've been in finance my entire life. My undergrad's in finance. I worked at PricewaterhouseCoopers right out of college, and I went to IBM, AT&T. I was corporate America for many, many years. Then I went to law school, became an attorney. Then I went to tax law school, became a tax attorney, practiced tax law exclusively, and then opened my own practice after being in finance and tax law my whole career. So I approach finance from a very, very different perspective as most money managers, stockbrokers, institutional money management, because I first and foremost look at everything through a tax lens. It does not do anybody any good if we build up $100 million for a portfolio, $50 million, $3 million, 100. It doesn't matter what the number is. If the government is going to have the ability to take 70+% of whatever I've built because of where I've put that money, then we have done a massive disservice to our clients. And what I think happens, David, if you look at the way Wall Street, the 401k, and all that history that I just kind of went through happened, Wall Street specifically, explicitly divorces itself from tax policy. They basically hooked onto the 401k, which we know was a pre-tax vehicle because the Roth didn't even come out until later, much later, 96 and 2006 for the actual work plans. And so it came out much later. So what that means is Wall Street attached itself to pre-tax wealth building, to building wealth in a silo that tax was not a part of. And as they accepted what happened organically, they just basically said, and they started just writing the disclaimers on all of the documents, all of the analysis and the statements, your advisor is not a tax professional, not authorized to discuss tax, go consult your tax advisor. And if you think about going back to 1978 for just 1 second, and 81 when it really started to become a mainstream vehicle used by corporations, we have to go back to the tax code of that time. And so that was Ronald Reagan's first term in office. Of course, taxes were outrageous. I know you've talked about it, Power of Zero, the tax train, all of these things. We have talked incessantly. And even though we shout on the rooftops, David, and we scream these messages, less than probably 5% of Americans have ever even heard them. And that's where we have to break through. We have to get the message out to resonate. But the fact is, if you go back to the early 80s, we had the top tax rate passively in the 70s and the top active rate in the 50s. So when the pre-tax wealth building came about organically, people were like, wait a minute, you mean I don't have to pay the high tax that's due right now on this earnings? I can put it into this silo, I can save it up, and I can wait until I retire. And because I'm in a lower bracket when I retire, I'll pay less tax. And that made so much sense, except for they forgot to tell people one thing. And that is, in order for you to be able to choose your tax rate when you're going through your lifetime, we have to have relatively stable taxes. If tax rates go like this, our plan's out the window. So assuming that tax rates are stable over time, then it makes sense for you when you're in your high peak earning years to not pay the tax and wait till you retire. When you go below the line in your low, your earning years, you're just Social Security, some withdrawals, and you're in a much lower tax bracket. So that made sense. But if you fast forward to Ronald Reagan's second term, when he passed the tax reform of 86 that went into effect in 87, he dropped the top bracket to 28%. Now, a lot more people fell into that bracket. So he widened it so that basically you fell into the top bracket if you were making $28,000 a year after deduction. So you were in there. So we had a lot more Americans fall into the top bracket, but he lowered that bracket to 28%. And if you think that 5 years later, David, after the 401k really came into prominence, if people went back and said, oh, time out, stop, I'm paying an effective rate of 28% or less, because that was the top bracket, right? So maybe I don't need to defer this money at 28%. That was the lowest bracket we had since FDR in the 30s for a top bracket. That was the lowest since 35 in FDR. Nobody did that. We were addicted. In 5 years, we were completely addicted to tax deferment, and it didn't matter. They could have lowered the tax rate to 15% and people would not have even budged. They were just addicted. And so now the tax train cometh, exactly as you say. And what is the singular dichotomy event, the event that will shift us into the new phase of taxation in America? You and I both know it's the retirement of the baby boomers. It's the thing that we've been talking about since the 70s. We knew since the 70s that this time period that we are in right now, between 2020 and 2030, this was the decade where everything that we've been pushing down the road will come to fruition. And that is where we are now. And that is why my message, your message, it's so important that we resonate and we get out there. Listen, what will happen once the boomers are fully retired? If you have all of your pre-tax wealth and pre-tax IRA and 401k, and you haven't done any mitigation to deal with that, it's a problem. It is a tax trap, because we know the CBO gave us an analysis in 2008 that basically said the middle class tax bracket will be somewhere in the 60s and the top bracket will be somewhere in the 80s. And this lowest bracket will be somewhere in the mid 20s, 25-ish. So these are European style rates, because we will, for the first time in the history of our country, be supporting a European style system for a third of our people. You know, we'll have about a third of our country on Social Security and Medicare. And if you think of the sandwich generation, you and me, the ones that are still working, we've got the kids that are in school underneath us, and we've got the people retired in front of us. And we just don't have enough workers in the working generation to support all this without massive tax law changes.
You talked about David Walker in your book. David Walker's a personal hero of mine. As you know, I talk about him in the very first paragraph of The Power of Zero, and he came on our podcast about 6 months ago, and I asked him about a comment he made back in like 2009, 2010 on PBS. I asked him, I said, you said back then that tax rates would have to double to keep our country solvent. I said, do you still stand by that statement? He says, not only do I stand by that statement, but I can give you a statement that you can take to the bank. Yeah. Tax rates today tax rates in the future will never, ever be as low as they are today. I mean, this is the tax sale of a lifetime. Every year that goes by where we're not taking advantage of historically low tax rates is potentially a year beyond, 2026, where we could be forced to pay the highest tax rates we're likely to see in our lifetime. The other thing that I like to tell people to help just put into perspective why Wall Street is so much different than advisors like you and me is Wall Street, I say, why haven't you ever heard of this stuff before? You have to ask yourself how major money management institutions make money. They charge you a fee. So if they have $1 million of your dollars sitting in the tax deferred bucket, they charge you 1% per year. They're making $10,000 per year off you. No big deal. That's part of how you and I get paid. But if they were to persuade you that tax rates down the road are likely to be dramatically higher than they are today, you might feel impressed to shift that money to tax-free by way of a Roth conversion. And let's say you pay 30% along the way. Now you only got $700,000 in your tax-free bucket. They're still charging you 1%. Now they're only making $7,000 per year. They just received a pay cut for persuading you the tax rates in the future are going to be higher than they are today. And that's why most major money managers, that's why Wall Street doesn't want to touch this conversation with a 10-foot pole. They just, it just does not benefit them to broach the discussion of taxation, which is why you and I think, are gaining traction. At least our ideas are, right? So let's talk a little bit about what's driving tax rates higher. This is a drum that I beat all the time. It's a drum that you beat all the time. You talk about a perfect storm in your book. What are all of the elements of this perfect storm, or what are the implications for baby boomers who have the majority of their assets squirreled away in tax deferred accounts?
Oh gosh. This is the big question, right? So as you know, and you and I are preaching to the choir of each other. So it's really for the audience, because you and I are on the same exact page. But, I think that I was worried before Corona. David, I really looked at that 2008 study and just was horrified as a tax attorney, thinking, Lord, the biggest threat is the tax. The biggest threat is not the market volatility, although that is a massive threat, especially right now. I see mean reversion coming very soon, 60 days. I would tell people to go conservative, extremely take your profits and go conservative. Just general information, because it's definitely, we're coming down to mean reversion here really fast. So before Corona, I was extremely concerned. Once I saw how the world dealt with Corona, I'm mortified. There isn't a word to describe how scary of a fiscal position we are in and specifically America precariously American because of our special status in the world as the world reserve currency. So to put in perspective for people, America decided to deal with coronavirus through stimulus. So we had the CARES Act, the HEROES Act, and then AFP, which was passed under the Biden administration in March of 2021. So that's 3 acts. That's about $6 trillion right there. The Federal Reserve has been buying, or quantitative easing, you can call it whatever you want, MBS purchases, mortgage-backed securities and treasuries of about $120 billion per month. So that's an additional 1.3 trillion we've stimulated in the last, per year in the last 20 months. So we have over $8 trillion of printed stimulus currency in the United States of America. To give your audience a perspective, Ronald Reagan took office in January of 81. We did not get to $1 trillion of debt until October of 81, his first year in office. So from October of 81 through February of 2020, our federal debt was just under $29 trillion in that long of a time frame. So you're talking about almost 40 years to get to 29 trillion. In the last 20 months, we have printed 8 trillion to deal with Corona. So I was worried before Corona. Now I am at the point of we're talking about a global central bank reckoning. And I'm not exaggerating. That sounds like some crazy right-wing conspiracy theory. Everyone wants to say these things, but I'm telling you, the globe, including the United States, the globe printed $25 trillion of currency to deal with Corona and counting. So now this comes back to the American precarious position because we are the world reserve currency since Bretton Woods 1944. What does that mean? It used to be that China and India did not bilaterally trade in their domestic currencies. They would buy dollars, trade in dollars. Okay, so then you had the BRICS, Brazil, Russia, India, Central America, I forget the C for a second, and S, and I also forget the S. But the point is BRICS, which is really Russia, India, China. China is the C. I forget the S, is it South America. You had these countries saying, we're going to make a pact and we're going to bilaterally trade for the first time. So we have already seen in the last, I'd say 15 years, a massive jump forward and the dollar not being used in bilateral trade amongst countries around the world. So that was already happening. But what you had happen now with China 3 months ago is you had them announcing that they kicked out all of their blockchain miners and they announced they're doing their own digital currency. You had the UK now just 2 months ago announced they were following suit on moving to digital currency. When the world moves to digital currency and everything is in bytes, zeros and ones, the US dollar literally becomes irrelevant. It becomes irrelevant as the world's reserve currency. It becomes superfluous and unnecessary. And to put that in perspective of how that would have an immediate impact on us, all you have to go, Dave, is you just have to go to usdebtclock.org. Go to usdebtclock.org. You will see how much money we have spent for the year, almost $7 trillion. And you will see how much tax revenue we pulled in, almost a little over $4 trillion. That means $3 trillion, nearly half of our spending on an annual basis comes from our ability to sell our paper to the world. And if that opportunity ends, and it will end eventually, we lose almost half of our lifestyle, whether it's supporting the military, whether it's going to checks for people that need, some social safety net, whatever that money is being spent for, we lose half of our ability of our lifestyle overnight. It's like literally thinking, okay, you're retired now and your half of your income is what you have to live off of. Only we will be going through that as a country. This is being pushed by the IMF, the World Bank. These things have been coming for a long time. And I hate to be hard on America, but it's our fault that we did not take the bull by the horns and say, what are we going to do to cement our importance in these transactions? Or are we going to let our American dollar be lost to the SDR, the special drawing rights, the basket of 5 currencies? Are we going to let China take this? There's a lot of currency issues, but the second we go to digital, besides the control factor, which is a whole nother problem. I have a Starbucks right next to my office. I go down there frequently and get my little Starbucks, and it's a cashless Starbucks now. They know me, and so this happened. I didn't know they went cashless. And I went in, this all happened over the virus. I took my $20 bill in to get my drink, and they said, oh, Rebecca, we're cashless now. We can only give you your change on a Starbucks gift card. And now this is a franchise location. And I said, you need to have your owner call me. I said, this guy does not know what he's doing. He is enabling the ability for us to, understand, David, the second you saw this administration say they wanted reporting of bank accounts, anything over $600, when you have digital currency, where do you think all the transactions are stored? Who do you think has access to your records? We Americans, and this is the lawyer side of me coming out, we have a right under the First Amendment, as guaranteed and interpreted by the US Constitution and the Supreme Court, that we have a right to privacy. We have a right to privacy. And I am so tired of people saying, well, I don't really care if anyone sees it because I'm not doing anything wrong. You say that now, but do you really want the government to know that you went and bought this there and this there, or you went to see this movie? It's nobody's business. It doesn't matter if it's right, wrong, black, red, and different, doesn't matter. We have a right to privacy, and we're giving it away by giving up our currency like it's nothing. And it's not nothing. It's everything to America.
You touched on something that's a real hot button for me, and that's the countries, because we denominate our debt in US dollars, we really have the ability to print as much money as we want to pay for whatever spending initiatives we see fit. And that's we've been doing it for years, but there's this movement afoot called modern monetary theory, headed by a lady who...
Keynesians.
Who's that?
I was going to say the Keynesians, but go ahead.
Yeah, so there's a lady named Dr. Stephanie Kelton. She ironically has the same literary agent as I do. And she wrote a book called The Deficit Myth that's really popularizing this idea that we can print as much money as we want to pay for whatever spending initiatives, and as long as it grows the economy, it grows the pie for everybody, and inflation won't ensue. That's a radical contrast from how we've conducted our finances over the arc of the history of our country, which is to say that we have two ways of controlling our budget. We can either raise revenue, reduce spending, some combination of the two, just like an American household. Modern monetary theory says, well, the American household runs their finances differently than the US government runs their finances, because the US household doesn't have the ability to print, to tap into the infinity bucket, which is to print unlimited amounts of US dollars. Do you have any thoughts about what would happen to our country if that type of thinking were to take root?
Well, I think it has, don't you? I think that's where we are. And I think that's why I'm telling you that we're at the precipice of the central banks collapsing under the weight of their own inability to really, it's really a debt enslavement from the very jump. Let's just be honest. Now, MMT, as far as MMT goes, I will just state unequivocally, I am, and I intentionally, they're going to love me saying this, but I intentionally joined the London School of Economics Global Executive Program because they are, pretty liberal, and I'm on the opposite school. And I thought, hey, to learn how they think, you got to go and learn from them, right? So I'm in their school of thought now. And, I think that MMT is just very clear. It can be just decimated, I think, from Corona. And if you don't see that with the US government printing $8 trillion and the equity market going up over 40% from our high pre-Corona with no economic fundamentals to support it. We have 10 million job openings. We have supply chain issues. We have interest rates and inflation that are outrageous. Interest rates way too low, inflation way too high year over year. And that's just core CPI. And we know core CPI was, affected or infected, we should say, to pull out energy and food a long time ago. So even if you compare CPI today to CPI of the 80s, it's different because we changed the definition of core CPI to exclude food and energy. So MMT, if we don't see that MMT is just plainly, transparently, and undeniably failing in front of our face, I don't know what else we could possibly say. You might say that they are going to try to blame the supply chain problem and that it's not really inflationary, it's the supply chain problem. And that's just not true. We can see that before we had the tanker sitting off the coast of California, we had year over year price increases of over 5% and hard data and hard numbers. So MMT is just that. It is a theory, and theories get disproved all the time. And I think that if you see the world printing 25 trillion globally and you see the prices of everything everywhere going up, then you don't have this inability. MMT, basically, for your audience, says that we can print indefinitely and forever into perpetuity as long as we can service the debt. But you know what MMT makes you demands, requires that you do, is that you no longer believe in inflation. Because if MMT is true, then inflation will never occur, because as long as we can service the debt, the money supply will be maintained and stable, and we should not see price increases. And yet the law of economics is just too big and too right to bow to the theory of MMT. And that is why you're getting true hard inflation that is, even after it's being manipulated by the US government's manipulation of taking out food and energy, you can still see massive price increases year over year that are not transitory, which is why Powell came out in the last couple of weeks and said, okay, it's time to stop calling it transitory. It's time that we stop simulating. It's time, let's taper. Let's have 3 interest rate hikes next year. Because why? Because MMT is going to be proven false.
Okay, folks, that's the end of the first half of my interview with Rebecca Walser. Of course, if you're looking for any help to implement any of the strategies we talked about today, head on over to davidmcknight.com. Happy to connect with you with a member of our elite POZ advisor group. And if you are a financial advisor looking to incorporate these principles into your practice, head over to powerzero.com, opt into our free 3-part video series. Folks, thanks so much for being on our podcast this week. We will look forward to chatting with you same time next week.